Welcome to Crypto 101, a first principles jargon-free course on blockchain and its impact on financial services. In this introductory lesson, we will define what crypto assets are. We will also get introduced to the benefit of crypto assets. So, without further ado, let us dive in. A crypto asset is a digital token that resides on a blockchain network. There are two concepts here that requires elaboration. First, the concept of a digital token. Second, the concept of blockchain networks. We will next turn to each of them. A token is a physical or digital symbol that is ascribed economic value by those acquiring them. They can be either in physical form or digital form. Next, we will review examples of each type. Physical tokens are physical symbols that have economic value in a defined context. Casino chips are an example of physical tokens. The defined context is narrow. The chip can be redeemed for cash but only at the issuing casino. A subway card is a physical token that we can use to ride the trains of a city. A currency note is also a physical token, but the defined context is much broader than a poker chip or a subway card. It can be used within the borders of a country or, in the case of the euro, even across countries. Digital tokens are equivalent of physical tokens residing in digital form. An example is a virtual gift card that can be used to buy goods at an online marketplace. Another example of a digital token is a QR code from a parking app. You can scan the QR code against a reader in a garage and get access to parking. Virtual currency used in gaming platforms are also digital tokens. The context within which the above examples are used is quite narrow. We define crypto assets as digital tokens on the blockchain network. Now that we know what digital tokens are, it is time to learn what blockchains are. To understand blockchain, consider what happens when you upload a photograph on social media to share with your friends. There is a central server that is controlled by the social media company. All your friends can access the photo by logging into that central server via the internet. Next, we will see how this differs in a blockchain. In a blockchain network, there is no central computer. Your computer and your friends' computers are all communicating with each other via the internet. Your photo resides in all the computers simultaneously. Each computer is known as a node, and together the nodes form a blockchain. Next, you make some changes to copy the photograph on your computer. But that is not the official record on the blockchain until all the computers in the blockchain network record it. The official blockchain record is the one that resides on the multi-node blockchain. This is somewhat similar to your downloading a bank statement and making changes to it. The bank statement on your computer is not the official record. In our blockchain diagrams, the nodes are shown to be directly connected to every other node. However, in a blockchain network of say 10,000 computers, that need not be the case. But the same peer-to-peer information sharing is achieved via what is called a gossip network protocol. A change in record in one node is transmitted to a few peer nodes, and these peer nodes in turn transmit to their peers. What you see on this screen is a more accurate diagrammatic representation of blockchain where each node has a few neighbors to which it is directly connected. However, we will periodically revert to the direct connectivity representation for the sake of simplicity of explanation. At this point, you may be wondering what is the use of storing records in this duplicative way. It seems rather inefficient. You are right. This is inefficient for the purpose of storing a personal photograph. However, this loss of efficiency is a worthwhile price to pay in other use cases. We will learn more about those use cases later in the course. If a blockchain is a network of computers connected to each other by the internet, who owns the network? In a public blockchain, anyone can join the network by connecting to the other computers via the internet and downloading free software specific to that blockchain network. For instance, the Bitcoin blockchain is a public blockchain. The software code that powers Bitcoin is available to anyone, though only few core developers are allowed to change the gold copy of the software code. Ethereum is another example of a blockchain network. In a permission blockchain, a central entity needs to give permission for anyone to join the network. While such blockchains deviate from the original vision of a decentralized system, they may be more suited for enterprise use cases like banking. The use of the word token may lead us to imagine them to be individual tokens on the blockchain. This need not always be the case. Next, we will learn the distinction between recorded versus measured tokens. Recorded tokens are those where each token is recorded individually. You can count how many unique individual tokens you have. For instance, a currency note is a physical symbol that can be counted individually. Even if currency notes did not have unique serial numbers, you can point to the $5 bill that you gave someone. In measured tokens, the tokens are not uniquely recorded but their total count or amount is recorded. Next, we will review an example. The balance displayed on your bank account is a digital symbol that signifies economic value. Hence, it meets our definition of a digital token. However, there is a difference between currency notes and digital money. Say the balance displayed on your bank account is $100. This is a digital symbol that signifies economic value. But each of the 100 units of US dollar in your bank account, unlike paper currency notes, cannot be individually identified. Crypto tokens can be individually recorded or measured. Next, we will look at one example of each. An example of a recorded token is a non-fungible token or NFT. At this point in the course, we will not attempt to understand what they are. Right now, I will only focus on demonstrating that each token is recorded uniquely. First, I will navigate to the website blockchain.com. Then, I click on the link to NFTs. We can see a number of images. Let us click on one of them. The image is called Endless Nameless. Now, I will scroll down to details. Note two fields. The first field is the contract address and the second field is the token ID. The combination of these two fields is a unique identifier of the NFT. This is akin to a serial number on a currency note. This code uniquely identifies the image, which was called Endless Nameless. As we scroll down, we can see transactions between users associated with the NFT. You probably have many questions on what NFTs are and what is the point of assigning unique identifiers to images. We will cover NFTs later in this course. The takeaway for now is that this is an example of a recorded token. Such tokens are discrete objects like a currency note with a unique serial number or an Amazon gift card with a unique barcode. An example of a measured token is a Bitcoin. We will now go back to the website blockchain.com. We can now shift our attention to the part of the site that lists various Bitcoin transactions. You can see that the screen is changing every second as transactions are being executed every moment. We can note that the symbol BTC is similar to the symbol USD. Bitcoin is a measured token. You don't own a specific token with a unique identifier. You can measure how many Bitcoins or fractions of a Bitcoin you own. But you don't own a specific token. Bitcoins are fungible tokens, meaning that one token is the same as another. Hence, there is no point in assigning unique identifiers to them. Let us quickly recap the takeaways. First, a blockchain is a network of computers which propagate information to each other via a gossip protocol and store the same information concurrently. Second, Bitcoin and Ethereum are examples of blockchains. Third, crypto tokens are digital symbols residing on a blockchain. Fourth, they can be discrete recorded tokens like NFTs or measured fungible tokens like Bitcoin. Finally, they are ascribed economic value by those acquiring them. We said that tokens, including crypto tokens, are ascribed economic value by acquirers. This means that those acquiring these crypto assets believe they can be exchanged for cash, goods or services. In fact, the use of the word asset itself seems to signify the presence of economic value. This naturally brings up the question on why crypto assets should have any economic value. Next, we will tackle this question in a stepwise manner. Before we get to crypto tokens, we can take a minute to assess why non-crypto tokens carry economic value. We can think of economic value of a token as arising from the benefit accrued to the token holder. A subway card entitles you to transportation. A parking voucher allows you to park your car at a garage. This brings to the logical question on what benefit is conferred by crypto tokens. In this course we will use the term crypto assets and crypto tokens interchangeably. The benefits of crypto assets vary by the type of token. Currency tokens allow us to pay globally without friction. Asset-backed tokens are designed to represent a claim on the economic value of a tangible or intangible asset. Ownership tokens, within which NFTs are included, allow us to prove ownership of a digital asset, physical asset or an intangible asset like a stream of cash flows. Utility tokens confer an entitlement on the token holder. For those new to crypto, this is probably not very clear. We will cover the various token types individually throughout the course. At this stage, the only takeaway is that the source of intrinsic economic value of crypto tokens varies by type of token. At this point, let us go back to our original definition of a crypto asset. We have defined what a digital token is as well as what a blockchain is. Next, we will bring the two together visually. On the left of our visual are digital tokens. You can think of them as simply data elements like rows on a spreadsheet. On the right is the network of computers on which these tokens reside. The tokens on the left reside in a duplicative way on each computer on the right. This brings us to the end of the first lesson. Before proceeding to the next lesson, please review the summing up section of this lesson.